Good afternoon, everybody. Thank you for joining us today. We're just going to give it another 30 seconds or so, just for some more participants to join, and then we'll get started. So good afternoon, everybody. Thanks for joining us today. A little bit of housekeeping before we get started with today's session. So the session is being recorded. So what we will do in the coming days is we will send out the material along with the slides for those participating in today. It's also worth noting we're actually running today's session to coincide with the release of our latest quarterly market reports. If anyone after the call wants to have a discussion in terms of our data capabilities in more detail, do feel free to reach out. Similarly, with regards to questions regarding any of the material you see today, my contact details and Paddy's, who I'll introduce in a moment, are at the back of the deck. So if you do have any questions, do feel free to reach out in due course. As I said, I'm pleased to announce that we're being joined by Paddy today. So Paddy is the Head of Operational Capital Markets at Colliers. And Paddy will be kind of taking over towards the back end of this session, really providing an update to the investment and development landscape. So I look forward to seeing what Paddy has to say there. In terms of today's topics, we've got quite a few to get through in a relatively short space of time. So we're going to start by looking at the latest demand data generated from the StuRents platform. We'll then look at how that demand has changed, particularly quarter on quarter. We'll then go through some of the latest planning application updates and updates to the pipeline. What we're then going to do is actually focus on the latest student visa data, which is now out for last year. And there's some interesting insights there. And then we're lastly going to be looking at the differences in search budgets really between domestic Chinese and actually Indian students as well. And again, there's some interesting insights we're going to cover. And as I said, finally, we'll pass over to Paddy for his update as well. So to begin with, let's start with demand. For any of you that were attending the Global Student Housing Conference a few weeks ago, you may recognize this slide. We've actually updated this just so it has the very latest data. But really what we're trying to do here is provide a bit of insight into demand growth per accommodation type. So on the left-hand side, we obviously have demand for HMOs. And on the right-hand side, we have demand for PBSA. Now, if we look at basically inquiries generated by the StuRents platform for HMOs to start with, year on year, we're up about 25%, and that's reflected by the kind of the dark orange line on the left-hand chart there. So, really strong, robust demand growth for HMO inquiries so far this season. The other kind of key takeaway from that chart, which is pretty clear to see, is the seasonality in the HMO markets. Obviously, the majority of HMO demand, so that's searches, inquiries, and bookings, is really taking place very early in the letting cycle. So as we progress through the rest of the cycle this year, we would expect those volumes to be relatively low compared to the start of the season. But as we can see from that particular chart, that is very much in line with expectations. Looking at PBSA demand, year on year, we're actually up pretty considerably. So we're up about 113% year on year in terms of inquiries for PBSA. Obviously, that is very much skewed, though. Last year, obviously, was impacted by COVID. So we're comparing that to a particularly low base. What we can also see from the data and the chart on the right-hand side, if we look at, for example, the inquiry distribution for the 22 season is that the market last year was very, very late. And you can see that the majority of all demand was occurring kind of July, August, and September. So as I said, positive that we have seen a big year-on-year jump in demand, but again, that is from a relatively low base. We are now kind of approaching the kind of the peak season for PBSA demand though. So again, we can see from the kind of dark orange line there, the level of inquiries for PBSA this year. Obviously, that's going to be very interesting to see how that plays out for the remaining months. And that's something we're going to obviously keep a very close eye on. And obviously, when we get to the end of the season, that's where we'll be able to do a bit more benchmarking in terms of PBSA demand growth this year versus last year. Moving on to search behavior, what we can do is use the data collated from the StuRents platform and start to look at how search behavior has changed this quarter versus last. So the chart on the right-hand side is showing of those searches performed on the platform, how are they distributed in terms of size? And what I mean by size is number of beds. And what we can see from the chart, if we start with the Q1 period, and Q1 actually refers to October to December last year, which is the first quarter of the new letting cycle. But we can see during that period, the majority of searches being performed on the platform were actually for 4 bedrooms. So that's going to be either a 4-bed cluster within a PBSA or a 4-bed HMO. And we can see also 5 and 6 beds, obviously popular as well. If you're going to group those together, we can see that about 81% of all searches during Q1 were for 3 beds or more. But that has now changed. So if we look at the latest data for Q2, which is actually January to March this year, we can see how that demand is starting to shift. So you can see that smaller sizes are slowly becoming more popular, and obviously larger sizes less so. And again, if we clump those larger sizes together, we can see that searches for 3 beds or more is now about, or was about 62%. So that obviously has come down quarter on quarter. That is very much expected. So that's kind of following the traditional cycle and in terms of seasonality. And actually what we saw from the previous slide was that most domestic students are house hunting very early or relatively early. Obviously, as more internationals begin to house hunt and search, we would expect a greater proportion of searches to be for those smaller units. So studios, 1 beds, 2 beds, for example. And again, that's a trend that will continue to play out for the rest of the season. What we've also decided to do is to look at budget growth. Obviously, the cost of living crisis, I think, is at the front of most people's minds. And what we really wanted to do is to see if that is really impacting the price points that students are searching. I think most students would have some kind of financial support, be it either a part-time job or maybe financial support from parents or guardians. And obviously we wanted to see whether that is impacting their budgets. What we can see from the chart on the right-hand side, which is tracking the weighted average budget that is being set by students when they're house hunting, is that the long-term trend has been very positive historically. Obviously, there are some month-on-month changes and seasonal fluctuations there, but in general, the trend has been very much upwards. Now, if we look at the latest data for the January to March period this year, the weighted average budget that was being set by students was around about £143 per person per week. If we compare that to the same period last year, it was about £135 per person per week. So whilst despite all these current headwinds with regards to the cost of living crisis, year on year, the average budget for Q1 or Q2, sorry, I should say, is about 5.9% higher. So there is continuing to increase, which is obviously broadly positive for the market. Part of that will be supply driven. Obviously, if you are a house hunting student and rents have increased year on year, if you want the equivalent property that you had last year, you obviously need to increase your budget to then basically find that property. But again, the fact that budgets are continuing to increase is obviously a positive sign for the industry. Moving on to look at some of the latest planning updates. So on this particular slide, the chart on the right depicts the number of new beds that have been submitted, and that's reflected by the bars on the chart, as well as the 12-month rolling total. And that just allows us to look at the trends over the long term. In terms of the latest data, what we can see is that in the first 3 months of this year, just shy of about 7,000 new PBSA beds were put forward. It sounds like a lot, but actually we'll see how that compares in a moment. If we compare that to the same period last year, it is up slightly. So in the same period of 2021, you're looking at just under 5,000 beds. So year on year, that has jumped a little bit. But as I said, that's really down on historical levels. So if we look back at 2020, for example, again, the same 3-month period, there were more than 14,000 beds added or submitted in one particular quarter. So again, that is reflected in the charts insofar as total planning activity has definitely slowed compared to historical standards. In terms of the number of beds approved in the last 3 months, so we're looking at about 5,300 beds were actually granted planning permission. That is down ever so slightly compared to the previous quarter, but is actually up slightly year on year. In terms of the total pipeline, we're now looking at about 110,000 beds in the pipeline at the moment, of which around about 80,000 already have planning application. And obviously the remaining 30,000 are essentially still awaiting a decision. Obviously in the current inflationary environment, we wouldn't expect all of those beds to be submitted, but it's still interesting to note obviously the total number of beds that's currently in planning. We've just picked out some particular developments here. This is by no means a comprehensive list. Obviously, it goes well beyond this. On the left-hand side, we have essentially new applications that were submitted in the last 3 months. And on the right-hand side, we have, again, just picked out some of those that received planning permission. So just to kind of run through some of these. So we saw, again, in the last 3 months, a very, very large scheme put forward by Downing in Leeds for essentially over 1,200 beds. Nottingham has been a very, very active market, which we'll come to actually shortly. But we saw a pretty substantial 790 bed scheme in Nottingham put forward, and actually some other schemes as well in Nottingham. There was another scheme put forward by Downing in Brighton for over 500 beds. And again, a relatively large scheme in Norwich as well that was submitted. In terms of those that were approved, so there was a pretty large 1,000-bed development done by Oxford Brookes, and that was, again, granted planning permission in the last quarter. Picking out just a couple of those in Nottingham that received planning. So we saw a 702-bed scheme, as well as a 293-bed scheme. And then finally, on this particular list, we have a 153-bed development in Haymarket Yards in Edinburgh that was also approved. Again, this is by no means a comprehensive list. Obviously, the list goes well beyond what we could show in one slide, but it just gives you a few of those notable updates. In terms of pipeline by location, so the chart on the right, again, we've picked out some of the largest pipelines there. But we can see that, as I said, Nottingham now has a very significant planning application pipeline. It remains one of, if not the most active markets in terms of new developments being put forward. And actually in the last quarter alone, we saw around about 1,700 beds submitted for planning. And again, as I said, that takes the total pipeline in Nottingham to around about 12,000 beds or just under. London's pipeline is actually larger in terms of absolute bed numbers, but obviously it's relatively small when you consider the total size of the London market and the total size of existing supply there as well. What is also worth noting is the locations that still very much seem to remain out of favour with investors and developers. Newcastle is an example of that. Cardiff is perhaps another as well. Obviously, those markets had a fair amount of supply delivered historically. At the moment, very little activity going on there in terms of new applications. Particularly interesting somewhere like Newcastle, where demand has continued to grow, yet, as I said, no real developments being put forward there. I think that does present some interesting dynamics, if not now, then certainly in 2, maybe 3 years' time, if demand continues to grow, there are question marks whether that's going to be met by additional supply, given that lack of pipeline. Additionally, what we have seen is locations like Sheffield and Coventry, to name a few, which again have been locations that have witnessed a pretty sharp increase in PBSA supply. And what we're now seeing in those locations is a real drop-off in planning application activity. And really that just comes down to, again, fundamentals in those locations, but also reiterates the fact that every location is very different. So you'll have locations like Nottingham, as I've explained, that are very, very active, whereas locations like Sheffield and Newcastle now are really not active at all. Moving on, what we've decided to also look at is student visas. So the data for the whole of 2021 was recently released, and we thought it would be interesting to look at how that has changed over time. On this particular slide, what we have done is we've looked at the student visas that have been issued by domicile, essentially, or albeit we've grouped that. And what we can see there is actually, if we go back to 2019, of all the student visas that were issued, around 42% were to Chinese students. Now, what is really interesting to note is how that has changed. So if we look at 2021, Chinese student visas equated to about 28% of the total. So yeah, a substantial decline in the proportion. Now, what is worth noting is that is not due to a decline in the number of visas being issued to Chinese students. It just reflects that actually the number being issued to students in other locations has rapidly increased, and Indian students is a prime example of that, which we'll come to in a second. On that point, on this particular slide, we have looked at that data over the longer term, which is on the right-hand side. If we focus on the data for China, which is the dark blue or navy line on the chart, we can really kind of see, again, over the long term, how those student visas have grown, and they've grown pretty considerably. If we look at, for example, the number that were issued in 2021 versus, say, 2012, they're up about 113%. So a significant increase over the long term. Obviously, what you can immediately see is the impact of COVID from that chart. And obviously in 2020, we saw a reduction of about 32% in the number of Chinese student visas being issued. Obviously, during COVID, something that we've discussed previously on these sessions, we saw a lot of positive numbers coming out still from the likes of UCAS and HESA, promoting the fact that international students still wanted to come to the UK. And again, that's very broadly positive for the market. But what we saw from the visa data is that they just weren't going to come, or fewer were going to come than normal, either due to travel restrictions or due to the continued uncertainty due to COVID. In terms of the latest numbers issued for Chinese students, so year on year we are up pretty considerably, about 48%, albeit that is from a low base due to the nature of last year. However, if we look at the numbers issued last year versus, say, 2019, they're still up. So they're still up 1.4%. Not a massive jump, but still in positive territory. Just for a bit of context, if we look at the rate of growth in previous years, in 2019, for example, Chinese student visas jumped by about 20%. So a significant rise. And actually in 2018 as well, they were up about 14%. So the pace of growth this year has not been fantastic. So it's going to be very interesting to see whether that is still a short-term blip due to COVID, or whether it's a general slowdown in the pace of growth in Chinese visas being issued. The other big kind of takeaway from the chart is the growth in visas being issued to other countries. Predominantly that's to Indian students, and we've seen a significant jump year on year. It's about 90% increase year on year. Again, if we look at the number of visas being issued to Indian students last year versus 2019, we're up about 165%. So again, a very big jump, both year on year and from levels reported in 2019. The other kind of key takeaway from the chart is the data for Europe. So that has historically been pretty static. What we saw due to Brexit was EEA students, so those from European Economic Area have basically lost their home status, and therefore that's why we've seen that bit of a jump in 2021, because those students are now having to apply for visas, whereas previously they didn't need to. Just to provide a bit more colour in terms of the countries that are the largest in terms of visas being issued. So China is still top of that, albeit is being rapidly caught up by Indian students. But we can see some of the kind of year-on-year changes there. So Nigeria up considerably, Pakistan, Bangladesh as well, albeit from a relatively low base. In light of those changes to visas, what we have looked at is budget distribution. And really what we wanted to do is to try and provide a bit of colour in terms of at what price points are Indian students in particular searching versus, say, Asian or domestic students. And what we can see from the chart on the right-hand side is they typically have a comparably low search budget versus Asian students. So the chart on the right is showing at what price points were either Indian or Asian students looking at properties on the platform. And what we can see from the data is that on average, Indian students were searching and looking at properties at about £140 per person per week, roughly. Whereas for Asian students, as we'd probably expect, that is considerably higher, about £182. So simplistically, it does appear that Indian students do not have the same level of budget as their Asian counterparts. Just to provide another comparison there as well, this particular chart, again, is looking at India versus domestic. And you can see that the spread is slightly larger for Indian students. There is a proportion that are searching for higher priced accommodation. But on average, again, Indian students' budgets are probably closer aligned to domestic than they are to Asia. And obviously, particularly for PBSA operators that may be either relying or trying to target Indian students, as we see that demand pool grow, it's just important to understand what their budgets are. And obviously, that might impact marketing, for example, and strategies around that. At this stage, I'd like to hand over to Paddy, and really excited to see what Paddy has to say about the market. So Paddy, it's over to you.
Thanks, Rich. Appreciate all of that. So I'm just going to go do a couple of slides, really more focusing, I guess, on some of the qualitative kind of views of the market so far this year, rather than the kind of the numbers. But starting off with some numbers, I guess we've seen PBSA investment volumes over the first quarter of this year are about 1.4 billion, which sort of is tracking in line with getting to a kind of 4 to 5 billion this year. I think it will be more than that. There are a number of portfolios at the moment under offer or coming to the market. Obviously, one quite significant one in Student Roost. So be interesting to see where those sort of trade. So I think we'll probably see overall numbers being fairly high this year, but and probably skewed slightly towards some of the bigger portfolio trades. But really what's happening behind all of that? Well, the capital landscape is continuing to evolve in the student space. And I think, the last 6 months has very much sort of seen that. We've seen a lot of capital allocation to student accommodation throughout the pandemic. For various reasons, but what we've seen, I suppose, in the last 6 months is that we've seen a lot more kind of lower cost, income focused money coming into the sector, where typically they probably would have been in the more mainstream sectors before, so offices, retail, logistics. So which I think probably says that to me that student accommodation is there's no question about it. It's a mainstream market now, and investors globally are seeing that. I think we're seeing, continued platform growth. With scale and big scale comes the need to manage and to have managers aligned to capital. So, we're definitely seeing appetite for platform growth continue. And I'm sure many on this call are seeing that within their own businesses, and being able to certainly control the way they acquire customers, the way that they operate the buildings, the cost of operations in buildings as well, which is is not unaffected by the cost of living crisis and increase in utilities costs and things like that. So it's very much sort of something that people are very focused on, and there's a way to control that often is through investing and growing in platforms. Just touching back on the capital piece, I guess why we're seeing an increasing focus on I suppose call it lower cost money that's focused on income producing assets. Well, really, I think the market is viewing student accommodation very much as contracyclical. I think we've all known that. That's been very much the kind of theory for the last 10, 15 years of those investing in the space. But the pandemic certainly highlighted that, and for many investors it was the first real experience of seeing student accommodation sort of tested, and especially now that we're going into, there's a lot more global and macro volatility in the world, and with recessionary fears in many sort of developed markets rearing their head. We're seeing a lot more allocation to these kind of counter-cyclical investments, and typically also looking at investments which are essentially sort of hedging for inflation. I think we've talked about the increasing costs, and that's a running theme I think throughout this. But there is a view that residential rents in general and PBSA to a certain extent tend to track inflation, and if you look at the growth of inflation versus rental growth, rental growth across the UK, that it has the sort of same peaks and troughs in the kind of broader sense. So investors are seeing student very much as a hedge for inflation. So it is now considered to be a safe asset class. I think the other thing sort of probably driving it in the UK is very much the sort of the weak pound, especially against the dollar. So American, US or dollar denominated investors are seeing the UK as a very attractive place to be at the moment, which is again driving the investment interest into the space as well. If I look at a lot of this capital that's coming into the market and looking at the market, they're relatively agnostic as to kind of what bed sector they want to go in. So whether it's multifamily residential, single family housing, co-living, student accommodation. However, student accommodation still offers a fairly attractive spread to mainstream resi, albeit in some markets that is compressing. And I think over time, we would expect to see that spread to be compressed and sort of come in line with what we've seen in the US. But the debate is that 5 years or 10 years away? I think we can debate that. But for the moment, in many markets, we're seeing that spread sort of be very attractive for investors. In some of the, I guess, in probably places like London and other markets which have an international focus, that spread is less, but it's certainly one of the drivers at the moment. And ultimately, it's where student accommodation is where investors can get income producing assets. They can't necessarily get them across other asset classes. Just looking slightly wider, I think the European markets, there is good capital allocation to do student accommodation across Europe, but I think the lower cost money is certainly finding it still to be too nascent to get significant scale. So which is meaning that they're just turning back to focus on the UK. So if people are looking, especially new entrants looking to do larger deals, they're finding it more difficult to do in continental Europe because essentially the stabilized stock doesn't exist. So they're coming very much into the sort of UK market. So I think, we're still a few years off, probably I'd say lower cost money at scale penetrating the European markets. I think really a kind of stepping back from it all, what's really interesting, I think from a PBSA perspective, and I talked about it being mainstream, but what we're now seeing is a kind of polarization in markets where there are some core markets and there are others which are, I would say, are less core, so kind of grade A, grade B markets, and where we're seeing yield compression across the kind of grade A markets, but probably less so pronounced across kind of B markets. And that's often driven by university quality, depth of market, and what's going on in the wider sort of resi markets as well. what's really interesting is that, as the sector has evolved in the last sort of 5 to 10 years, we're now seeing a real growth in the value add space as well. So first generation or second generation assets, which are now in need of quite significant capex, and owners who are not necessarily wanting to do that capex, we're looking to get out, and a kind of an introduction of this value add sector, which we've typically seen in obviously warehousing and retail and in offices, but now we're starting to see in PBSA as well. Just going on to the sort of development side of things, I think it's no secret to everyone the sort of challenges sort of facing development. Last year, there were about 30,000 beds developed in PBSA across the UK, which was kind of back to the long-term average. I think that's typically in and around what we've seen for the last sort of 5 or 6 years. I think some of that was probably a lag from 2020, where I think the numbers were more like about 15,000. So I think there was definitely a sort of makeup there within that. And to Rich's earlier point, there are it'd be interesting to sort of see where that goes and what translates from pipeline into actual completions over the next few years. And there are certainly some cities which we're seeing lesser pipeline, which I think is going to probably lead to some sort of price adjustments in a positive way in those markets. There's estimated to be about 27,000 to be delivered this year as well, which are on site and to be completed for this summer, which again is in line with that. I think what we're seeing for kind of new pipeline and new construction is very much sort of supply chain disruption, increasing cost of materials and labour shortages, which are really pushing projects at the moment to the edge in some situations, where I guess if you're sourcing materials overseas, whether that's the FF&E or other raw materials, they're finding that people are finding they're getting stuck at the borders, which is part of a Brexit piece, but also, container ships and containers being out of place is very much sort of causing havoc with sequencing on development projects. Obviously, it's not being hidden that there's lots of increasing cost of materials. That's raw materials, but also sort of manufactured materials as well. So doors, windows, all of those kind of things. But things like obviously like concrete, steel, have increased significantly over the last few months, which is really sort of challenging viability on a number of projects. And generally, labour shortages at a local level as well is meaning that people are just struggling to get the right trades and the right skills on site to meet timelines. I think new pipeline therefore is really being sort of challenged at the moment. And adding all of that in, we're seeing an increasing cost of debt. The debt markets are slightly more volatile than they have been for the last few months as well. So it's really, I think viability is going to come down to people's experience, the price they've paid for the land, whether those markets that they're building in are growing markets. So there's lots of sort of things which are being coming into play here. I think it's safe to say there's another side of this, increasing the cash flows are changing. We are probably going to see rental growth in many markets as well, in line with inflationary movements. But we will potentially see higher OPEX in some scenarios as well, and that's sort of being considered. I know at the student conference last week there was lots of talk around utilities and the approach to that. So I think that's very much something to be watched, and that's supposed to be watched and see how that comes into our thinking. Just looking kind of forward, as I sort of finish up, I mean, we've not really seen any significant reflection of anything in land wosts. I don't think we will do either in the short term. I think we'll probably see a period of inertia before we see any kind of movements in land costs. So would be very easy for me to sit here and say that we've got to see land costs come down to make these things viable. I don't necessarily think that is the right observation at this stage. I think we'll just see probably projects taking longer to get off the line, rather than any kind of immediate changes to land pricing. So I think it's going to come back to what are people wanting to build? How can they move the model forward? We may see more evolution of product and things like that as people try to be smarter around what they build. I think we'll see a bit more of a evolution of development structures away. away from kind of traditional funding models. Not saying that they're dead in any sense of the situation, but I think we're likely to see more cost sharing models and joint venture models, so that funders and developers can work together in a more volatile environment, so it doesn't all sit on one person's head, and people are sort of taking a joint level of risk to make projects viable. So I think we're certainly sort of seeing that now. And look, this is very much to be debated, but I think we may well see an increasing sort of spread in kind of development in investment yields or funding yields as well. Whether that's meaning that investment yields are moving in quicker than the funding yields, and I know we've seen that gap sort of very much narrow over the years, but just looking at the relative volatility in the development markets, I think for the capital looking to develop, I think we'll probably want a slightly better level of compensation to take that development risk, and won't necessarily follow the yield compression that we're seeing on the investment market in certain places. I don't know whether that is true, and whether that will happen, but it's just something for us to kind of potentially debate and move forward and speculate on. So look, Rich, that's it. Very kind of high level view. Probably lots of people disagreeing or agreeing with me in that, which is what I want. So there's lots of things to be seen for the back end of this year.
Paddy, really appreciate the update. I think there's a lot of interesting content there, and a lot of participants on the call will have found that interesting as well. That just leaves me to say thank you very much, Paddy, and thank you everyone for attending. That is the end of today's session. As I said at the start, our details are on screen at the moment, so if you do have any questions, do feel free to reach out. As I also mentioned, we will be sharing the recording as well as the slides in the coming days, so do keep an eye out for those as well. That's it for today. Hopefully speak to you all again soon, and enjoy the rest of your day. Take care.